In this lecture, we're going to be talking about dividends. First of all, just as an overview, dividends in general are some sort of distribution to shareholders. The two types of dividends that we're going to cover first are cash dividends, which is a distribution of cash, and then stock dividends, which is a distribution or distributions of shares of stock. And oftentimes we want to ask ourselves, so are dividends a good or are they a bad thing? Well, technically, they're actually neutral. And I'm going to try to walk you through why they're neutral, and then we can maybe talk about market implications later on. But basically, the shareholder's wealth is unaffected by dividends. Whether it's a cash dividend or a stock dividend, there's really no change in a shareholder's personal wealth. Remember, the shareholder, if it's, let's say, a cash dividend, the shareholder owned the cash when it was held within the company, and they own the cash once it's distributed to them. It's just a matter of whether they take the distribution and have it personally, or whether that cash remains with the company. Either way, it's still their cash, and so they're no better or worse off, other than maybe tax consequences when there is a cash distribution. And similarly, when there's a stock distribution, at the same time, they just have the same number of shares. In other words, I have now more shares, but my proportional share ownership is exactly the same. So if there's, as an example, a 10% stock dividend, and I own 10 shares out of 100, I own 10% of the company. After the distribution, I own 11 shares out of 110, and so I still have a 10% ownership stake. And so in both cases, their personal wealth is unaffected. I will say with the cash dividend, there are sort of two interpretations potentially of the cash dividend. First of all, it does suggest that they can operate and still distribute cash. That's maybe the sign of a healthy company, but it also means that they don't have any better uses of the cash than to distribute it to the shareholder. And so there's a potential double-edged sword there, where it could be interpreted as good information or bad information, but in a very technical sense, dividends are actually completely neutral, because the shareholder's personal wealth is unaffected by the dividend. All right, so there are some relevant dates that we need to consider when it comes to dividends. First of all, there is the date of declaration. That's when the board approves the distribution of a dividend, whether it be cash or stock. There is the date of record, and that just determines the current list of shareholders who will receive the distribution. And then finally, there's the date of payment, and that's the date on which the firm actually distributes the dividend, whether that be cash or that be issuing the shares. So we do need to kind of compare what might be accounting entries versus market effects from the dividend. First of all, accounting entries are going to be required when the firm declares and when they distribute the dividend, because that's sort of when there is an accounting consequence. So when the dividend is declared, now the company has a probable future economic sacrifice. In other words, they're either going to distribute cash, or they're going to have to make some sort of distribution of shares, which would be some sort of equity distribution that's going to take place. We'll talk about the specifics of it, but in both cases, they've committed to making some sort of distribution. And on that date, that's when we record the fact that it was declared. The date of record from an accounting perspective really doesn't matter, because that's just sort of determining which set of shareholders or what list of shareholders is going to receive the distribution. And on that date, there's really no economic effect for the firm. But finally, then on the distribution date, of course, that's when actually shares are issued. We need to record those shares being issued, or at the same time, that's when the cash is actually distributed, and so we would need to record that as well. From a market perspective, we have a little bit of a different issue. In other words, market effects are going to arise whenever there are changes in expected future cash flows. And so that's sort of from a very strict sense of it. And so when there's a declared cash dividend, we're going to kind of focus on cash dividends here for a second. If there's a declared cash dividend, well, if it's unexpected, then there's likely to be some sort of market effect. It could be good if the dividend is considered good news by the market, but the market could have a negative consequence, or a drop in stock price if it was considered bad, or if the dividend is less than what people expected. And so the date of declaration, there's likely to be a market effect if there's any unexpected component to the distribution. On the date of record, there's almost certainly going to be some sort of market effect because on that date, anyone who holds the shares is going to receive the cash or the stock, but whoever purchases it after that date, then they're not going to receive that cash or they're not going to receive that share. And so essentially what you see almost on that date of record is almost a proportional drop in the share price. Because if you could imagine, the day of record, I own one share of stock plus maybe, let's say, a $1 cash dividend. On the very next day, if I were to buy that same share, I would actually only have the share of stock, but I would not have that $1 cash dividend. So the stock price typically drops about the size of the cash dividend. And similarly, if there's a stock dividend, of course, the same amount of wealth is now being distributed over a greater number of shares, and so the market price will typically drop to reflect that drop in the number of shares. And so, as an example, just going back to that example, if I go from 10 shares to 11 shares, we might see the market price drop approximately 10%, to reflect the fact that now the number of shares has increased. And so the date of record usually is when we're going to see kind of more of a direct change in the market price of any shares that are outstanding. And then finally, date of payment, there's really almost certainly not any sort of market effect because there's no new information when the dividend is actually paid. All right, let's talk about a cash dividend example. Firm has issued 500,000 shares of common stock. Of those, 450,000 are outstanding. They have a $2 per share cash dividend. We have the date of record and the date of payment. First of all, it is important to note that cash dividends are paid only on shares outstanding. And so if there's a $2 per share cash dividend, it's only going to be paid to the outstanding shares, or 450,000 shares. And so because of that, we take the $2 per share, we multiply it by the number of shares outstanding, and we get $900,000. And of course, at this point, there is now a cash dividend that's going to be payable. That is a probable future economic sacrifice. That is a liability. There are sort of two ways we could handle the debit. I'm showing you what is probably the most common way to handle it, which is to directly debit the retained earnings because, of course, we're distributing the earnings of the company. Now, so I have seen a temporary account called dividends distributable or something like that, which is subsequently closed to retained earnings at the end of the fiscal year, but I think it's most straightforward just to debit retained earnings right away. Of course, then we have the date of record. There is no entry, but sometimes there will be a memorandum. And then finally, we have the date of the actual payment. Of course, that's when the payable goes away and the cash distribution actually takes place. So some more things to discuss when it comes to stock dividends. First of all, when we talk about small stock dividends, that's a distribution of 20 to 25% or less of the outstanding shares. And usually if you have treasury shares, they're not going to participate in small stock dividends. In some states, they'll participate if the shares are being held as compensation for employees. Other than that, treasury shares typically don't participate in small stock dividends. There will be a decrease to retained earnings, and under current U.S. GAAP guidance, the distribution amount is going to be based on the market value of the shares. Basically, they're making an assumption that the small stock dividend will minimally affect the share price, and so the share price is an accurate depiction of the basically the redistribution of earnings into sort of a permanent contribution, because now instead of having retained earnings, we're going to have those amounts in our common stock account, which basically means we have a permanent contribution that's being made. Again, there is no cash distribution with a stock dividend. You're simply distributing shares. So for large stock dividends, that's where there's a distribution of 20 to 25% or more. At that time, then, of course, there's a little bit of a different implication because there are going to be more shares being issued. And because of that, treasury shares typically do participate in large stock dividends, mostly because the share price is going to be greatly affected by a large stock dividend. And at the same time, because it's such a large amount, the market price really isn't used at that point. Instead, we're going to use the par value. And it's likely because the market value would be really almost inhibitive of the distribution, because it would just eat into the retained earnings so greatly that it would really prevent future distributions of cash and things like that. And so we use the par value. So small stock dividend example, firm has 800,000 shares that are issued, of which 700,000 are currently outstanding. The firm declares a 10% stock dividend on July 15th, 2018. We have the market price, the par value, and the original issuance. In this particular case, the distribution and the declaration date are going to be the same. Or I'm sorry, the date of record and the date of declaration are going to be the same. And so our first entry, of course, is we use that stock price of $25 per share. We multiply it by the 700,000 shares that are currently outstanding, and that gives us $1.75 million in a stock dividend. Of course, I want to be very clear, this isn't cash. This is just a value that we're assigning to the shares that are being issued. And so the common stock dividend distributable account is a temporary equity account, and that is just representing the par value that will eventually be assigned to common stock. Of course, we know the issues aren't actually issued on this date, and so we're not going to credit the common stock account until the issuance actually takes place. And so we have this temporary account that holds it in the meantime. And then, of course, we do have the additional paid-in capital account. That's any amount above the par value. That's the permanent equity account that we would normally see with a stock issuance. And then finally, we do have the actual distribution, and on that date we issue the stock, and that's why we now credit common stock and we get rid of that temporary equity account. So for a large stock dividend, instead of being the 20% or whatever, now we're up at 50%, and so we can see that there's very clearly a distribution of more than 25% of the common shares, and therefore this is a large stock dividend. We give you the same information, but of course hopefully we know that the par value is the only relevant amount. In this case, retained earnings are going to be debited at the par value. Again, there's 50% now. Because this is a large stock dividend, all shares are going to participate in it, including those that are being held in treasury. And so it's going to be 400,000 shares that are going to be issued. And so retained earnings is going to be debited for 400,000, and then that temporary equity account is credited for 400,000. And then finally, the shares are issued, and of course, that's when we issue the common stock. $400,000, again, 400,000 shares times $1 per share par value.